Now, of course, this is not a recommendation to buy or sell stocks, ladies and gentlemen. This is me just kind of going over opportunities that I think I'm seeing here in the market. Welcome in, everybody. So in this video, I want to talk about opportunities that I think are taking place in mid-cap and small-cap type companies. Well, technically, they were mid-cap companies that have sold off so much that they're starting to approach that small-cap type valuations. We're talking about 2 billion and below. So anything 250 million to roughly $2 billion is considered to be a small cap, and anything $2 billion to about $10 billion is considered to be a mid cap type company. And so let's talk about the pros and cons of buying mid cap and small cap companies. So mid cap and small cap companies are definitely considered higher risk because they're more interest rate sensitive to the environment, because they don't have the type of balance sheets that your larger cap companies have. They don't have the sustainable earnings growth that your larger companies have. They're very susceptible to negative downturns and interest rate environments. So when we look at the Russell, which is your small cap index, versus the S&P 500, as we saw rates kind of remain elevated for longer, we started seeing that separation in performance with your small cap companies. So the blue line is going to be the S&P 500, while this red line is going to be your Russell 2000. And so we can see the underperformance here on the Russell. But deep into these types of companies, the mid cap and small cap companies, I do believe there's some serious opportunities with companies that have strong enough fundamentals to kind of get through the downturns and possible recessions. And they're kind of getting discounted here. So let's talk about some that have sold off that I think could be some opportunities. Now, one that's starting to approach some interesting territory, as I brought up before, is going to be Under Armour, which is just under $3 billion market cap now. And I do think that the fundamentals are strong enough to get through the next few years if we go through a downturn. And as I mentioned before, they have some defensiveness built into their business model because the athleisure and the athletic side, regardless of what's going on in the economy, is still going to be in high demand or decent demand versus your traditional clothing stores. Another one that I think is getting interesting here is going to be Papa John's Pizza, now approaching small cap territory, trading at 23 times earnings, and it pays a 3% dividend. Now, this one is definitely dealt with the high cost, a lot of different issues, but we're starting to see the consumer now slow down, maybe start watching their budget a little bit more. We saw good earnings come out of Domino's. Papa John's, to me, has some back-end earnings growth with the opportunity of opening 50 new locations here. And so for a small cap company, I do think this one's starting to get interesting. Now, this one might be one of my favorite small cap companies, trading for $515 million, trading at 16 times earnings. This is my wife and I's favorite Mexican restaurant. Chuy's is a very, very interesting company. I really hate the restaurant business overall. Low margin and very dangerous, very sensitive to pricing, very sensitive to the consumer, very high risk in my opinion, not a tremendous amount of reward. But when you're buying them at these types of valuations, I really do think they're very, very interesting here. This is a company I think still can grow a lot. They're opening new locations and they're running a pretty good business model here. Trading at 16 times earnings with the growth opportunity and being under $1 billion market cap, definitely have my eyes on this one because it's also attached to my wife and I. We think that this is a good restaurant, and it's always nice to invest in things that you personally use and buy. Of course, this is just my opinion. I always recommend just dollar cost averaging into a broadly diversified index. Set it, forget it, come back in 30 years and you'll be just fine. But for this entertainment purposes, the stock I actually want to dive into is going to be Sam Adams Boston Lager. It has a $3.2 billion market cap here, and it's starting to approach that mid to smaller cap market area. We can see that the stock was pushing nearly $400 a share, now at $275. And the crazy thing is this stock traded as high as $1,200. Now, I just want to go through their portfolio here. They obviously have Sam Adams, which I think most people are probably familiar with, Dogfish Head, which was a growing IPA, Twisted Tea, Angry Orchard, Truly, which is probably one of their more recognizable brands. And they also started getting involved in weed-infused alcohol beverages. Pretty unique business here. They have a very nice portfolio that they've been building over the last couple years. Recognizable brands. The company was founded in 1984, IPO'd in 1995, so they've kind of been through some downturns here when we think about the dot-com bubble, the 2008 financial crisis. So this is a company that's kind of been through the ups and downs and still kept their brand alive and well. When we look at top-line revenue growth, going from $900 million in 2016 to fast forward to 2023, doing over $2 billion in top-line revenue. And it's never been a good straight line here. When you're dealing with the consumer, you're dealing with inflation, and you're susceptible to those types of things, you're going to see the ebbs and flows, but the steady growth up is kind of what we're looking for. That trajectory up is what we're looking for. And we definitely get that with Sam Adams. As we talk about a lot on this channel, stock price is always going to follow that EPS. So when we think about that company exploding up and then absolutely collapsing, we'll take a look at earnings per share here. Steadily growing, had a huge spike up in 2020, collapsed in 2021. But guess what? They're actually trajecting back to their normalized EPS here. And this is why I'm starting to find this company interesting, along with them adding new stuff into their portfolio. The one thing I do like about the company is the free cash flow is starting to get stronger here. 2021 was just a bad year for this company, and we can see that steadily they have decent free cash flow here. One of the areas we want to see, especially these smaller cap companies, really start to get more efficient is return on equity, return on invested capital. So they're getting around 8% return on invested capital, 9% return on equity. I think this is pretty decent, but obviously we want to see double digits. We want to see 10+% growth here. When we look at experts giving their price targets for the company, we have as low as $250 and as high as $422, with the majority of experts putting a hold on this stock. So a few things I want to point out about this stock. Number one is this is a very low float stock. There's only 12 million shares of this company out on the market here. So we can see here Sam Adams is definitely trading for a premium on almost every metric you could look at. So let's highlight another thing that I just pulled up in their quarterly report. They paid off all their debt. So right now the company has zero debt and $205 million sitting in cash. They also bought back shares. So first thing I want to do is take out their total debt here. I'm going to leave about $10 million just to build some safety in here in case if they take on some debt throughout the year. And I'm going to knock down their cash to $200 million. So stock analysis has them growing right around 3% with an EPS of $10.16, which is in line with what they're guiding for, between $7 and $11 of EPS. So it looks like stock analysis has some pretty good projections here for growing that 3 to 5% area, and I feel comfortable with that. So we get two price targets here for Sam Adams. We get a multiple of EBITDA coming in around $206. Now, I want to make it clear, this is me putting in a 10%, looking for a 10% rate of return, but also building in safety here. Cautious in my growth rates. I was cautious in their balance sheet, which then also lowers the price as well, a few percentage points. So really, when we're looking at this, I'm probably looking anywhere between a 10 to 15% rate of return for a company like Sam Adams here. And we get a $206 price target with a $255 price target. And when we build in a little safety, we see $230 here. So for me, Sam Adams is a buy between that $206 to possibly $240 range. And so it's trading around $275 to $277. And it's fallen off pretty drastically here. So another 10 to 12% fall could be an opportunity here to be looking at Sam Adams, which is not too far away here. So as always, guys, hopefully you enjoyed that, and we will see you in the next one.